Stop scrolling, because the next 6 months could decide who gets rich quietly and who gets crushed loudly. Silver isn't moving. Silver's waking up. And if you're only watching the price, you're missing the real story. The system underneath the price is starting to crack, and when that happens, silver doesn't climb, it snaps. Quick favor, I'm running a campaign to push back against copycat channels that recycle other people's work. If you value original breakdowns, hit subscribe and drop a quick comment like OG John AG, so the algorithm knows you're with me. Now here's the uncomfortable truth. People keep asking, is it too late? And I get it. Silver already ran above that old breakout area. But the market doesn't care about your feelings, and it doesn't care about your anchors to old numbers. What matters is structure, and structure says we may still be early. Because silver's valuation versus gold is still way off the page. It's still cheap in a way that almost looks like a mistake. And historically, when that kind of mistake gets corrected, it doesn't happen politely. It happens in a burst that leaves latecomers staring at charts like they're reading a foreign language. So today I'm going to walk you through the pressure points nobody wants to talk about. Why the gold-silver relationship is flashing rampage. Why the real threat isn't a stock crash but a bond shock. And why the next wave could be faster than most people can emotionally handle. And yes, by the end, I'll tell you the one simple idea that makes all of this click. Why owning just 1 kilo of silver might be the most asymmetric move you make this decade. Before we go deeper, I set up a WhatsApp channel for daily updates, quick posts, and my personal analysis, plus instant voice notes and fast alerts that I don't put on YouTube. The link is in the description. Join it so you're not late when things move. All right, let's start with the key question. Why are people still saying not too late, even after a breakout? Because the breakout you're seeing is arithmetic. The bigger signal is relative, the spread, the ratio, the internal tug of war between silver and gold, silver and stocks, silver and the entire paper asset world. When you look at silver versus gold, you can see it clearly. Silver has been discounted for so long that the discount became normal. People accepted it. The market accepted it. And then, almost quietly, silver began pushing through the ceiling. Here's the catch. Even now, that ratio is nowhere near historic extremes. We're not talking about a return to some fantasy number. We're talking about a reversion to relationships that have already happened before, twice, in modern history. That's why it's too late is the wrong frame. The real frame is, are we in the early innings of a move that reprices silver's role in the monetary system? And I think the answer is yes. Now, if you want the cleanest mental model, picture a spring held down for years. Not days, not months, years. You can press it and press it and press it, and nothing looks dramatic until the moment you let go. The release doesn't happen at the speed you expect. It happens at the speed the spring stored. That's how silver behaves when it finally catches up to what supply, demand, and monetary stress have been building underneath the surface. And speaking of stress, let's talk about the part of the market everyone ignores right up until it's too late, government debt. This time is not a housing crisis story. It's not a bad mortgages story. It's a sovereign debt story. And that's bigger than the stock market, bigger than the tech bubble, bigger than whatever headline is trending today. Governments are drowning in obligations, and the core asset, government bonds, has become the quiet risk that could suddenly turn violent. That's why, when central banks step in and start buying bonds, they don't do it because they're bored. They do it because something is breaking or about to. They call it liquidity support. They dress it up with polite language. But if you translate it, it means if we don't intervene, yields spike, and the system panics. And here's the part most people don't get. If bond prices go sideways, even after aggressive buying, that is not strength. That's a warning light. Because it means the buying is not lifting confidence. It's only slowing the fall. So if bonds slip just a little, just a handful of points, suddenly you're not in a calm market anymore. You're in a scramble. You're in forced selling. You're in margin calls. You're in fire hose territory where everyone prints, everyone promises, everyone panics at once. And what benefits from that kind of panic? Not paper promises, not long duration debt, real money, gold, and especially silver. Now let's address the biggest fear people whisper. What if stocks crash and drag metals down with them? That fear comes from a myth that refuses to die. Yes, there was a famous moment when everything fell together, one brutal month where liquidity got so tight that even good assets got sold. But the aftermath is what matters. Gold recovered, silver products disappeared, premiums exploded, the shelves went empty, and then metals resumed the bigger trend while stocks kept suffering. The lesson isn't metals crash with stocks. Now the lesson is, in a liquidity panic, everything gets sold, and then the market reveals what it actually needs when the smoke clears. And if the coming stress is about currency decay and bond credibility, metals are not a side bet. They're the exit door. Now, I want to be very clear. I'm not saying the stock market can't wobble. I'm saying the stock market is not the main trigger. The main trigger is the bond market, because bonds are the foundation of pricing for everything else. That's why I keep calling bonds the quiet one. The quiet one doesn't talk. The quiet one just snaps. So here's the setup as I see it. Stocks can drift, chop, tease new highs, or slide slowly, while silver accelerates anyway. Because the fuel isn't risk on, the fuel is trust is leaking out of the money unit. Now let's talk demand, because people love to quote deficits and then act shocked that price doesn't move. Silver has lived in a supply-demand deficit world for years. The metal is used everywhere. Electronics, energy infrastructure, high-efficiency components, and the kinds of systems that make modern life look smart. And yet, price spent years acting asleep. So what changed? Pressure built, and then it started to release. When a market ignores fundamentals for too long, the catch-up doesn't come as a neat, incremental climb. It comes as a catch-up sprint, fast, messy, emotional. That's why you'll see silver move in maniac bursts that look irrational, but are actually a late correction to a long delay. Here's another clue that things are changing. When inventories in key hubs shrink while premiums stay elevated, it suggests metal is being pulled into strong hands. Not tourists, not casual buyers, strong hands. And when strong hands take control, the available float gets thinner. That's when price can gap. That's when charts stop behaving normally. Now let's zoom into the gold side for a second, because this is where the math gets wild. Look at gold's bull market history, not in opinions, just in arcs. In one major cycle, gold multiplied by roughly 8 from its bear low to its bull high. In another, it did something similar. So ask yourself, if gold has only done half of that kind of move so far in this cycle, what happens if the cycle repeats its own behavior? And then the bigger question, what if this time is not normal? Because the debt problem is not normal. Because here's the difference. Past cycles had inflation. They had monetary easing. But this cycle has a credibility issue in sovereign debt itself. If the world starts doubting government bonds, that is not a normal macro environment. That is a re-rate everything environment. And in that environment, the gold number is less important than the direction of trust. Now tie that back to silver. Silver doesn't need gold to go to the moon for silver to explode. Silver needs the ratio to normalize. Silver needs the spread to reflect what happens when people stop underpricing it. Even a move toward ratios we've seen before would be enough to shock most people. And this is why 1 kilo matters. Because most people don't think in kilos, they think in ounces. They treat silver like a collectible. But if silver is entering a phase where it reprices as monetary insurance, then size matters. Ownership matters. And the difference between owning a few ounces and owning a kilo can be the difference between nice story and life-changing leverage. Now, let me ask you something, and answer honestly. If silver ripped higher from here, would you be calm? Or would you freeze because you didn't buy when it still felt boring? Second question. If bonds started sliding and the headlines suddenly switched from soft landing to bond market stress, would you feel prepared, or would you be trying to buy after the crowd wakes up? Drop your answer in the comments, because I want to see how you're thinking. And while you're down there, if you're successful in any area, business, investing, career, share one win in the comments. Real wins motivate real people, and you never know who needs your story today. Now, we need to talk about the next 6 months, because this is where the chart stops being a chart and starts being a decision. The next 6 months are the window where spreads decide whether they're breaking out for real or faking out. But here's what makes me lean bullish. The structure has already shifted. Silver isn't just rising, it's starting to outperform. And when silver outperforms, it tends to do it in waves. Wave 1 is disbelief. People call it a dead cat bounce. They say it's over. Wave 2 is frustration. People wait for a pullback that never comes. Wave 3 is the chase. That's when it turns into a stampede. We're somewhere between wave 1 and wave 2 right now. And the reason I say that is simple. The public still isn't positioned. Most people are still staring at stocks, staring at AI names, arguing about earnings, acting like the bond market doesn't exist. Meanwhile, the real foundation is creaking. Now, I'm not here to tell you to sell everything and hide in a bunker. I'm here to tell you to read the room. Because the room is changing. If central banks are forced into more intervention, the money unit gets weaker. If the money unit gets weaker, metals get stronger. If metals get stronger, miners often get leverage strength. And if silver gets strong, it can embarrass gold in percentage terms, just like it has done before. So what's the clean play? I like simplicity. I like things you can hold, measure, understand. 1 kilo of silver is a concrete piece of preparation. It's not complicated. It doesn't need perfect timing. It doesn't require you to guess the exact top. It's an asymmetric bet on a world where money is being sacrificed to keep debt alive. And here's what I need you to hear. The market doesn't announce the moment you're too late. It only shows you after the move is gone. So don't wait for permission. Now, a quick creative side note. If you also enjoy real silver success stories, people who actually turned smart moves into serious outcomes, there's a separate channel linked in the description. Check it out and subscribe, because those stories can rewire how you think about opportunity. All right, back to the bond risk, because this is the cliffhanger people keep missing. Watch the long end of the curve. Watch the 30-year. watch what happens when support fails. Because if that market slips and central banks respond by blasting liquidity, the first reaction will be confusion, and the second reaction will be a dash into hard assets. And if that dash starts while inventories are tight, the price response won't be gradual. It will be violent. Now, here's another attention point. Everyone thinks they'll have time to buy when it's obvious. But when it's obvious, the premium is higher, the delivery is slower, and the good opportunities are already gone. This is why early feels uncomfortable. Early feels lonely. Early feels like you're doing something slightly weird. Late feels popular. Late feels safe. Late feels expensive. Pick your discomfort. And here's the trick the headlines will pull. The moment silver pauses for breath, they'll declare the run finished. They'll parade experts, cherry pick one red candle, and tell you the smart money already left. That's your test. Because if this is a repricing, pauses are not endings. They're reloads. When you see a moment, don't relax. Zoom out. That's where the real signal lives. Now, one more thing you need to know. By the time you're watching this, a members-only video should already be live. It bundles the latest updates and my deeper, in-depth analysis in one place. If you're truly following me, consider joining the membership and watch that video, because it also tells me who's really locked in. And yes, I'll keep bringing the public breakdowns here, but the members get the tighter, faster, more detailed version. So where does this leave us? It leaves us with a market that's sending signals most people don't want to interpret. Silver is cheap relative to gold. Bonds are the quiet risk. Central banks are leaning toward intervention. The money unit is being sacrificed to keep the system standing. And silver is the metal that tends to move last and then move the hardest. So here's my ask. If you want daily updates, join the WhatsApp channel in the description. If you want the full bundle of updates, check the members only video. And if you want to support original work and help eliminate copycats, subscribe, hit like, and comment. OG John AG. Now I want to hear from you. Do you think the bond market is the real trigger this year? Or do you think the stock market steals the spotlight first? And second, if you could only own one hard asset position for the next 12 months, would it be gold, silver, or something else? Drop it below. I read the comments, and your answers shape what I cover next. Take care of yourselves, stay sharp, and I'll see you in the next one.